Well, good morning, everyone. Again, Glenn Thompson checking in, and welcome to today's program. I'm going to start. We are recording. I just hit the recording button, so if you miss any portion of the session or if you'd like to review, you can access the recording at our website. Welcome. For those of you who have not heard me do a presentation or a webinar before, as you see on the screen, I'm Glenn Thompson, and I have been working since the beginning as a mentor with Pacific Trading Academy. You can get in touch with us at the website www.pacifictradingacademy.com. You can also utilize the toll-free number 800-339-8588. And we're going to talk about my latest and recent research concerning stock prices in the broader stock market. Deciphering the stock market is today's title. If you have questions as we go, you can indicate them on the control panel section of your screen on the right side, and I'll be happy to address them. And then I'm sure there's going to be time for further redress at the conclusion. It's not a lengthy presentation today. Just want to show you the latest. So let's proceed. And again, just write in the questions if you have them in the area on the right side of your screen, and as best I can, I'll try and keep track of them as long as it doesn't impede the flow of the slideshow. All right, so what's going on in the stock market and how can we profit from such? Let's just say, all right. Timing is critical in a lot of the decisions I make. I just a few days ago, in response to a time target, as I'll indicate in more detail in a few seconds, initiated long positions in the broader stock market. I trade the E-mini S&P, but the analysis is specific to the major stock markets in the United States. The geometry of the decisions and the analysis applies across the board, whether you trade SPY, the Dow, the NASDAQ, Russell, any major index. In this case, there are some cases where there will be divergent behavior between one index relative to another. In this case, it's generally across the board applying. Market timing should always take precedence over price, and I'll indicate my latest and most recent time projections for the stock market that I've projected recently that go out into the end of the year. I've actually, as recently as yesterday, generated a time point for the stock market, March 23rd. Curious, well, let me hold off, but timing should, suffice it to say, should always take precedence over price. And I mean that from a cause and effect vantage point. I ultimately, vis-a-vis the technical approach, give ultimate and attach ultimate importance to price. It does discount all factors, and that is the fundamental premise of the technical analysis idea, that all information is contained or embedded in the price. So if we learn how to interpret price, we should learn what price is more likely to do, or we have a keener sense of that. However, in terms of clarity of understanding, I believe that all of the price returns and changes that occur in price are a function of different time periods. So I'll indicate that as we go forward. On a higher level, capital or monetary flows are directed by from the vantage point of money flows towards the greatest, or towards an instrument or sector where it expects the greatest return to be achieved. And so I'll point some of the evidence I have from my view on the stock market indicates this and ties into that. So this is kind of a broad overview. So that also speaks more precisely to taking a focus at the interest rate curve and current interest rate policy, which in turn informs money flows, which in turn informs the specific character of a sector or an index or a market. This is just a slide to indicate certain intermarket connections or correlations. These are standard. The two rows at the top indicate the normal relationships between the US dollar, commodities at large, the bond market or interest rate sector, or any basically bonds and stocks. So you can see the normal relationships, and then there's some adjusting or nuanced adjustments of those standard relationships if we go through a period of inflation or deflation, right, as indicated. And I'll kind of reference this in some of the slides that I want to point out. All right. My premise is, at the moment, in my view, is we're going to see, at least in the short term, higher stock prices. This is a 25-year chart. It's a monthly chart going back 25 years, I should say, of the stock of the S&P. I formed my view in part based on my market timing models, as well as incorporating wave analysis, Elliott principles and structure. This bottom right here, if you can see on the screen, it's the lowest point, is March of 09. And if you recall, that's the end of the big, this is the top back in 08, the start of the kind of economic, I won't call it a depression, but the recession. This is the, you can see kind of a double top structure. And then all of this move from the top that formed in 08 down to the bottom, it essentially ended in March of 09. I recall specifically it was a Friday afternoon when that occurred. We have been in a raging bull market since March of 09. So for essentially the last 7 years, we've been bidding and lifting stock prices across the board in the United States. There's some obvious wave structure here in a broad global sense. If you look at this top right in here where you see my mouse moving, that would be the first impulsive wave of a bull market. This pullback here into this bottom I define to be a second wave, a correction 2, all the way up to the recent top, or more recent top, in May of 2015. This topping price, that was an area, a price level about 2118, 2119, if you can see or kind of interpolated from this screen here. And that was May of last year, May of 2015. So all of that move from this bottom here up to this top is a very textbook-like structure for wave 3. And then the pullback into the double bottom area below, just below the 1800 zone, at a price of, what's that, about, actually more precisely about 1785 and change. That's your correction wave 4. Well, if this bottom, the double bottom just under the 1800 mark, corresponds to the end of a correction 4th wave, it's the start of a 5th wave, and I think that brings us to the present. So again, everything from the bottom of March of 09 to the top here, I actually forgot the date, wherever this is, if I can figure it somewhere, it looks like in 2011, maybe late 2011, that's your wave 1 of the bull market. Your correction 2 is the bottom that came in about, was that 5 or 6 months later. Kind of in the 3rd quarter probably of 2012-ish. And then everything from there through the top in May of last year is your wave 3. It's a classic textbook wave 3 on a number of counts. And then you have a 4th wave, very relatively shallow as a percentage retracement of wave 3. And then that occurred at that ended at the bottom price of around 1785, just below 1800 area, as you see. And essentially we've been rising in what I expect is a 5th wave. Well, if you, from the one point, from a time standpoint, just the amount of run time on what I determine as a primary scale, this is old age. This bull market is rather in senility. From a time standpoint, if I say on average you've got a primary cycle lasting roughly 4 years. I submit there are probably a number of primary cycles within this of a shorter degree or a smaller degree. But overall, essentially, we've been moving up since that bottom in March of 09 through the present. And we see, as observed on the monthly chart going back for this amount of time, clearly evidence of 4 and a fraction total waves. And I submit we're still in wave 5. One of the calculations I did to suggest that by itself is not sufficient, but combined with other tidbits and other situations I'm seeing and other more recent, more local phenomena in the price suggests there's further in this particular wave. Purely from a Fibonacci standpoint, we understand that 5th waves ideally would trace out or run an extent or meet an extent of approximately 61 or 62% of 1 through 3. So if you measured the distance from the bottom of the bull market, the start back in March of '09, through this top up here, if that's 1 through 3, the top just over 2100 area, and that's actually 2118 and change. If you took that distance, the range of motion for that the market moved off of the bottom of March through the top in May was 669.25, so roughly 670 points. That's wave 1 through 3. The market traveled that amount of points in that amount of time. If you take 62% of that, oh, I'm sorry, I did the calculation. Yeah, the range, the range here from this bottom to this top is 1,449 points and a half, so 1,450 for 1,450 points. The 669 was the low of March of '09. That's where I knew something was not right there. This entire move from the bottom back here at 600, we're at 669 low to over 2118 here. That's a difference of 1,450 points basically. So if you take 62% of that, you get 896 points. You add that to this bottom right here, just below the 1800 area, and as a projection, you get a price target of 2,680 for the S&P. So we're at 2,150. So this is certainly, by that calculation, it suggests that the bull market is still got some life left in it. It's not at the point of death. It's not at there's no death knell at this point. It's not imminent from a Fibonacci perspective, assuming ideal formation. Now, we also take into account that fifth waves relative to wave 1 and wave 3 typically don't travel as far. What the phenomena of fifth wave truncation often sets in. Even if we assume that the market, if our ideal target is 2680 and we're at 2158, we're 500 points below. So even if you traveled 50% of that, we're still going to travel considerably further in what would be the final impulsive or motive portion of the long-term generic bull market. You see, so that's from a global, more macroscopic argument for expecting higher prices, and that the bull market that began again back in the March of '09, first quarter of 2009, which for the last 7 years has been in existence and has a number of different shorter term or shorter degree cycles within it, is still in effect. Again, our ideal target is 2680. We're at 2158, so we're more than 500 points below that, suggesting conservatively we could travel at least a third, or if not 50% higher to complete the final stage of the initial 5 waves of a bull market portion of a market cycle. So it begs the question, is this market, or is this bull market that began, the global bull market beginning in March of '09, complete? By that reckoning, I would say no, and that is an indication to suggest higher prices, more in a longer term view, are in the offing. All right. This is the daily chart of the E-mini S&P. Or let me stop right there. Any questions just based on the previous slide? Anything? No? So far so good. All right. Now, this is a more recent chart. I printed this out yesterday where I've calculated, this is the December, the near-term E-mini futures, the December contract for the ESZ, and recent activity. The 2158 is a critical price level. These are price levels I wanted to indicate. And again, from a technical standpoint, price does discount all information. I am cognizant of that. The reasons why have to do, in my estimation, and as a Gannett kind of devotee in a sense, have to do with certain specific periods of time. Nevertheless, even if you're not aware of that, ultimately just being aware of certain levels of potential anticipated support and resistance will be critical. 2158 is kind of where we settled yesterday. If you can, I don't know if you can see that on the screen. I'm going to, it's a little dark, but it's 2158.1 is the actual close at the day set at the end of the session for the week yesterday. And that's interesting. This horizontal line that I've drawn, my crosshairs, I purposely positioned right at that level, at 2158. It happens, it's an interesting, well, no, it's not, I don't believe it's coincidental. 2158 I calculated to be an important level to which prices will resonate and gravitate. So I'm not surprised that the market closed at 2158.10 yesterday. This is an important level based on a number of different types of models and mechanisms or relationships that I utilize to generate important prices to which I can expect the market's going to kind of revert to or gravitate to. Certain prices are magnetic, if you will, to use a figurative term, from the vantage point that we find often the market will make an excursion. It'll engage in its particular return, but it finds itself gravitating back towards certain levels of support if it's higher or moving down, or if it's moving up to zones of overhead resistance. So we settled just essentially for all practical purposes at 2158. This is an important level of support and resistance. It's as graphically illustrated by the horizontal line here. If you can't see that, I can hardly see it, so you probably cannot. But the market did settle basically at 2158 yesterday. You can see at the bottom of the candle here, the final candle on the right, the black or closed candle. All right. The next lower zone of support I've projected is 2130. Again, these numbers are basis the December E-mini S&P, the ESZ16 contract. All right. If you're trading SPY, you just shift the decimal over essentially one place to the left, and you have the similar range roughly. All right. As I mentioned at the outset, if we're looking at the Dow or the NASDAQ or the Russell, the structure for the 80% of the structure will be very similar, even though this axis of price is calibrated differently. But the structure, and for the most part, most of what I'm saying will be across the board applicable as well and apply. All right, the next zone of overhead resistance I projected is 2176. Now, this top right here, if you can see it, that was August 23. It is the highest point historically that the S&P has ever traded. That, if I recall, that came in on this, although it's not marked on this chart, but that's August 23rd, this little white candle with that tail or wick sticking, forming the highest historical top of, it was 2180. 84, I believe, or yeah, something 2183, 84, somewhere in there, the highest top to which we've traded. So prior to taking the historical tops out, and you got a little triple top here, essentially this top, and this top right here, essentially within a point or two, the same top, a little triple topping area, indicating graphically the historical highs of the market. But a little before we can deal with that, the market, based on the calculations I've generated, 2176 seems to be an important number. And then if we break out through that, then the historical tops, the 2184 level that came in, that are the all-time historical highs traced out on the screen, we break through that, the next zone of overhead resistance I've calculated is 2195. And then, of course, much higher, much more globally projected from the previous chart when we looked at the monthly chart going back 25 years, from illustrating the move from the start of the bull market in March of 09 through where we are at the present, generates a price target, or more than 500 points above the current bottom here, 2680 to be precise. So it does suggest higher prices. More locally, though, one of the other the next subsequent slide will illustrate my wave count. I have these little lines in here to illustrate the triangular formation, and looking to expect a breakout, as we saw earlier just a few sessions ago. All right, we got long on the day of the breakout. Not solely because the market broke, but in part, yes, clearly we allowed the market to kind of act as a tour guide of expected most probable direction and course. And I utilized the upper side of the triangle and the lower side as an acid test. the idea being earlier strategically, whichever particular the upper or this bottom side of the triangular structure that we first saw the market break through would be an indication as to its more the trend that would set in motion until the next stopping point or turn point that my time rotation slide will show. So we are currently long from about 2152, I believe, 2150, 2152 on average, a number of positions. All right. So these are just the regional zones of support and resistance. The current level, as again reflected by this horizontal line, happens to be, and I submit it's not coincidence. I did not put in 2158 because the market settled there yesterday. It happened to have settled there yesterday. Look at the number of, look at the frequency of times that, look at all the top area in here. Look at the number of times, this bottom right here, the two bottoms for the last two sessions, or the top of 3 days ago, yesterday's close, the day before is almost just below it. The frequency with which, going back for a couple of months now, that the market resonates to this 2158. I calculated that via using what's called a nonagon chart. It's a GAN instrument that I utilize to generate this number. So it's a very important number. We are at a critical stage in the evolution of stock prices here in the United States. In the next 2 weeks, week in particular, as you'll see in the subsequent slide, I feel will have a lot to say in terms of how we move forward for the balance of the year into the final quarter. And then I'm going to coordinate that with some fundamental bits and pieces of relationship, and as best I'm able to make sense of it and interpret it. All right. All right. With regard to the previous slide where I've indicated the degree of importance I place on my time projection, the vertical lines indicate two of the recent, or three now, of the recent past time target projections, and I've gone out to the end of the year. As I said, I've already projected one time point, March 23rd of 2017. I didn't put it on the screen because of space considerations in the formatting of the slide, but I've already projected out March 23. That's interesting because similar to the most recent, where we just, this past week, September 19, those of you who I work with on a regular basis know I've been harping on the time point of September 19. It actually was not, it was the 18th and the 19th, since the 18th was last Sunday, and because we don't have a full session, even though the S&P opens up on Sunday, it's not a full session. I went with 9/19. I also had a number of cycles coming in on the 19th, so between the 18th and the 19th. So that's the most recent time target, and that's represented by this vertical line where you see the date, September 19. Prior to that, we had a time, just to illustrate the mechanism and what this indicates for us when it works. It's not always reliable. It is sometimes amazingly reliable. For the last 8 months, I have been accurate probably more than between 80 and 90% as far as the time targets are concerned. I have reason to expect similar levels of reliability for the time projections or points out into the future. Because of the techniques and the relationships I'm exploiting, if they worked that well in the past, there's some indication they should similarly work well in the future. It's not a guarantee, and I'm not placing decisions or making trading decisions, much less placing money on bets in speculative positions solely on the time targets, but does serve as I think, a very efficient adjunct to my price analysis. All right. I was a day off, June 28th. The actual bottom by a couple of points was 627, and I projected that weeks, if not months, prior to. If you recall, this was the aftermath of the British vote in, the referendum on whether or not Great Britain would stay, the Brexit as we call it. So it was, again, I'm not sure to what extent one could have profited from this information or not, but these are the data points that the analysis generates. June 28 was a past one, and then subsequent to that we had an 8-1. It was a perfect top there that was perfectly reliable. And then most recently last week, September 19th. So with respect to the recent 9/19, we projected last Monday. The break actually, depending on how you interpret this chart, it would form the bottom 2 days later. Curiously, on the 21st, and I knew this in advance, I knew that to the extent I was expecting a reversal or a break in one direction or another, given my projection of September 19, when I looked on the calendar, I remember months ago generating this date, and when I looked on the calendar to see what, if anything else, of significance might be occurring calendrically or cyclically, I also realized it's the calendar quarter, the autumnal equinox, and this calendar, the equinoxes, the solstices, etc. The calendar, the 4 points every 3 months, we have a calendar quarter as we mark out and move forward through time. It turns out the stock sector in the United States and interest rates, stock markets and bond markets, or debt markets in particular, are in a macro sense very much informed by the calendar rotation cycles, the planetary cycles that dictate our seasons. So I kind of, in a sense, coming into this past week, expected a window of time within which, between the 19th, this past Monday, and the 22nd, Thursday, which was the exact autumnal equinox point on the calendar. So we were at least within a window of expectancy between Monday and Thursday, the 19th through the 22nd, expecting a major change to occur. So far, so good. We have seen a breakout, and then I used the upper side of that price triangle to serve as a threshold of price resistance through which, if we saw a break, would be more indicative that the market would have build up a head of momentum and more likely persist. Yesterday's close, somewhat of an inside formation with respect to Thursday, 70% correlated with trend continuation of what type of motion preceded it. So that, again, is a small component from the price that does suggest higher prices are to come. Now, that's the past. June 28, August 1st, very reliable. September 19, pretty reliable within that window when you factor in the equinox cycle of Thursday. All right, now going forward, the next projected time point for the stock market is October 3. Well, that's not too far off. That's just, today is, let's see folks, today is the 24th, so we are talking just over, in calendar days, not just market days, just over a week away. It's 1 week from this coming Monday, as I look at the calendar. So we're talking basically 5 or 6 trading days or market days until we arrive at this point that I've marked off as my next point for which I expect change. What does that indicate? What does that tell me in a practical, tangible, working, how do I interpret the analysis, the output? Well, it indicates from the simplest vantage point, what you start from the conjecture that whatever the market's doing, whatever type of motion is present presently, you expect it's more apt from a continuum of probabilities to continue doing what it's doing until it doesn't. So essentially, these vertical points indicated with the dates that I've written in indicate points where it's more likely you will see on or about those dates change. One type of change is an outright 180-degree shift of direction, trend reversal, market top, market bottom formation. That's the basic vanilla starting simplistic, most simplistic explanation and takeaway of interpretation. Does it always work that well or perfectly? My mind immediately, I don't want to say I'm afraid not, because actually I'm glad that it doesn't. If it worked that clockwork-like, it would be too discernible, and then it would no longer work because too many traders would have ultimately get a grip on it and recognize it, and ultimately its impact would begin over time to trail off. No pun intended. Over time, the time counts and time targets would lose their definition. But when you factor in the fact, when you consider that less than 5% of traders are privy to the types of relationships that generate this type of information, clearly they are tend to be 70 to 90% reliable in a vacuum, in isolation. So I'm referring in a real world sense about applying these time targets in conjunction with price information that serves to further reinforce and prop up the efficacy and importance and relevancy. All right, so far so good. So at the very beginning, way to think about this, what this suggests is when people ask me in the last few sessions and people I consult, if they had similarly established long positions one way or the other in a broader U.S. index, what's the run time? For the first question I typically get is, where do we think we're going to go? What's a price target? 90% of traders, if not more, think in terms of price. We are programmed to think along the vertical axis because that immediately translates into the amount of our P&L. What's our profit? Certainly, I understand that. But I think of it, I back it up and I go a little deeper. I go down and dig down one level deeper into the basement and to look to see if I can investigate the precursor or the promulgator, if you will, of price action. To the extent the run time correlates with the run distance. The horizontal determines the vertical or dictates the vertical. More in general, in an obvious way, the more time a system, and I'm thinking of the stock market now, I'm going to connote it or define it as to be a very complicated dynamic system, components of which at times are more linear, at other times more or less linear, sometimes non-linear. There's an inner high mixture of different varied types of motion. So the more time a system has to do something, the greater extent of that something. So from a price time standpoint, the less time a market has to travel, the less distance, assuming a linear component of response. Now that's a big assumption. A market could behave non-linearly. In other words, what I'm saying here is my estimated run time for the market based on my projected output here is say 6 days or 5 days. Next, if we include all of next week and the following Monday, which is the 3rd of October, that gives us 6 trading days. For what to occur? For the current status or type of motion currently in place to persist or to maintain. So it begs the question, at least in a qualitative sense, how far do I expect a system which is rising or a market trend that's currently on the up to continue? Well, I don't know, but it ought to be somewhat proportional to the amount of time it has to continue doing what it's doing. So in this case, it's relatively, how do we define what's long and what's short in terms of run times? I don't know. It's a relative question, but it is what it is. So I expect, at least conservatively, the overall trend to persist between now and, say, next Monday, more plus or minus. A week from this coming Monday, which is 10/3. And then in principle, you'd expect a rotation. So then I've already projected out November 4th, November 30. Curiously, the day after Christmas. Well, I looked on the calendar, my actual projection happened to be by a number of different cyclical factors. I use planetary cycles, I use geometric cycles, I use price cycles, I use a numerical manipulations. I generated December 25. Curiously, Christmas Day. This year it happens, when you look on the calendar to see, you'll see that it happens to come in on a Sunday. Either way, the market's not going to be open. So whenever that happens, you project the closest fit time point, which is the following day, the Monday in this case. And then as I've already projected out to March, the subsequent time point of March 23rd, which is essentially one and the same as the calendar quarter at that point, January, February, March. That is the other calendar quarter, and so I'm not too surprised about that. That's not to imply that the market cannot turn at times other than these dates. These are just dates that my analytical radar screen has generated. Doesn't mean it doesn't mean the market can only turn on these dates, assuming even if you're that in sync and that much of a believer in the efficacy and the reliability of these time points. All it means is that on or about these dates, you can expect, to the extent they are valid and the analysis is free of error, error has not crept into the procedures of application, that when they are appropriate and they are in sync with what's occurring in the system we're studying, that you can expect there is a greater than average probability for a change in that system to occur on or about that time. It doesn't mean that the market is verboten to change or reverse at other times. It just means there is a greater propensity for the market to change or turn on or about those times. So in principle, when I want to layer in more understanding, a little finer detail, the procedural thought is asking myself, or begins from the process of asking myself, what type of motion is present at the time of arrival to any one of these time points? At its most closest point of contact on the horizontal temporal timeline, as it arrives, is the market, and there are essentially three major general degrees of motion allowable for a price chart or for a system, a stock, bond, commodity, any financial market, up, down, or sideways. Is it going up? Then it's more likely to leave that point in time in a different manner, say down, or vice versa. If it's coming down at the time of contact to one of these time points, it's more likely to leave the scene in the opposite way. If it's going sideways, well, it could go either way. And thus, when you had this triangular structure, that was more or less a triangular sideways consolidation within a restricted range for an extended period of time. Typically, you have theoretically the breakout occurring prior to the apex or the vertice of the triangular pattern. And in this case, and more often, now, I was coming into this week, I was bearish, not bullish. And it was I actually, a week ago yesterday, last Friday, sent out an initial order to the people who are on my email list for trade signals to go short. And I did it, though, by placing a sell stop underneath my support, under the lower side of the triangle. The logic, or the rationale being, allow the market to break through support to trigger my entry to the short side of the market. But, and so it's a good thing I did. I alternatively had thought to do a straddle, buy calls and puts, same strike, same expiration, and then just watch to see the direction of motion, and then jettison the non-performing side of the straddle. And I thought that was a little too conservative, given a plethora of information I had to suggest a change was imminent. And then what happened this past week on Wednesday, it was the announcement of the Fed for a further delay in interest rates. That was the fundamental news event, if you will, that served as the appropriate trigger or catalyst to create the breakout to the trend that I expect will conservatively run or be in motion at least through the next time target. So this is an illustration as to how I use the time targets. They effectively function as rotational points on the temporal dimension, and then I look to combine that with all other types of information, be it technical, cyclical, fundamental, etc., you name it, quantitative, whatever at hand, and try and reconcile and create more complete filled-in pictures of probable course for the market. All right, so you kind of have a sense as to what at least my research is indicating it results. For the short term, when short term in this case again means simply the next week, 5 to 6 trading days, I expect prices to be at minimum. Now, also, let me caveat here, let me point out, again, these lines, these time points are not always, it's not so simple, not so facile as to indicate simple, always tops and bottoms. Life would be too easy if that were the case, but they are more, generally speaking, thought of, or I think of them as points of change. Granted, one type of change is outright 180-degree shift, but it's not the only. So I have to look in and act and incorporate this information with my other bits and pieces, everything from that I think is relevant. So in this case, I see yesterday's action is very, coupled with the candle preceding on Thursday, it suggests a little period of quiescence and rest, correlated 70% with continuation. And we've got from the previous slide, my next zone of we're at 2158 in terms of price. My next overhead zone of resistance, 2176. And then if we break through that, 2184 is the little triple top area, the historical highs. We break through that, we're going to 2195. And you can see this is the 2190, 2195 would kind of be right in the middle, 2184 is kind of right there, and then 2176. So kind of more or less 10-point moves I can at each stage incrementally at which we would find the market running into some resistance. So we'll chart it moment by moment, day by day, period by period to see to what extent in that tug of war between the price relative to the levels of overhead, kind of layered zones of resistance, how the game is played out. All right. So this slide again indicates the extent to which I expect the time when the time points will come into play. All right. Connections. These are just, this kind of in a different sense more directly illustrates what the previous slide at the beginning indicated in terms of general correlations that we typically see. So the one I thought of something else to be, there's one other point, a nuance, let me come back. I mentioned, I wanted to add something to this. I mentioned that coming into this past week I was more bearish, and that had to do with a wave count. If you go up here to this highest, the historical top, I thought that was the end of a fifth. I was thinking it could be the end of a fifth wave that started of a cycle that began back in January 20th. This chart got cropped off. This is the January 20, imagined to be a bottom back here. And then this is wave 1, this is the top here, wave 2, wave 3 ends right here. All of this action from this top right here in April through the bottom in June is your fourth wave, and I was expecting that this was a particular fifth wave, the highest point on the screen. Well, if that's the case, I was expecting that everything since the highest point on the chart down to this bottom was either an ABC correction or maybe possibly the A of a larger ABC correction. I'm not perfectly certain that even at this point what it is and how to define the price action from the very top of the screen through where we are today in the context of the wave pattern or wave principle. What I clearly see is fourth wave triangular structure. This could be wave 1 from the very top, this initial thrust down to this bottom right here where the pointer is. That's wave 1. I thought this was a very deep pullback or correction. That would be wave 2. The 2-day collapse, if you recall, 2 weeks ago, that was the regional, one of the regional bank presidents made a comment concerning the idea that they thought rates would be raised sooner than later. The market collapsed. The following Monday, a Fed governor at the central bank itself made a contrary comment indicating that the fragility of the economy was such that the damage to delaying, by delaying a rate hike would be less extensive than the damage if we were to have a hike sooner than later. And as such, the market retraced to roughly 80%. And then ever since that, we've been kind of in this triangular. So I thought this was a fourth wave. That's why I was bearish. Because what happens after a fourth wave, if this is a bear market cycle, 1, 2, 3, and then all the triangular was 4, I was expecting a fifth to take it down. And I thought it would be in conjunction with my time window between this past Monday, and the 22nd, the equinox. Well, didn't see that. In spite of whatever interpretation or whatever a model or a set of relationships say, ultimately, at the end of the day, price has final say, or at least it does if you want to profit. You could have 20 different things or 200 different things telling you the market should go or move in a certain way. And if you get positioned accordingly and the market goes the opposite direction or some direction out of sync with your position, I guarantee you have a problem at that moment, or if you don't, you will in a few moments. There's no way around it. It's the point of the proverbial rubber meeting the road. So in retrospect, what do you do with that? How do you make sense of this? It's structurally, everything looks good up until the last point. Well, I could make a case for severe fifth wave truncation. In other words, if this bottom here lasts not this past Monday, if that's, oh, wait a minute, that was that this, yeah, that was Monday, Tuesday, Wednesday, no, that was 2 Mondays ago, excuse me. That was the Monday after the, yeah, if 2 Mondays ago, if that's the end of wave 3, which I think it was, and then the move up in the next session or so, or even 2 sessions, could be your 4th, or your little, all of that could be your 4th, and then this little tail down here could be a very, very short or runted or truncated fit. It's possible. I'm reaching, but there is precedent. You can have a 5th wave that doesn't even exceed the end of the preceding 3rd. But suffice, even to the, that's the best argument. I do have some structure historically traced out on the screen that does suggest that this bottom right here, this open candle, white candle, the tail could be a very short or truncated 5th of the A, because this is just the A wave of a broader correction, I expect. The move up from this bottom to where we are right now as of yesterday's close could be the B of an ABC correction. If that's correct, and we do have higher tops and move higher into 10.3, whatever price level, and we've had I've given you a spectrum of zones of overhead resistance. 2158 is where we're trading right now. 2176. 2195 is what I've marked, but I'm also aware of the potential zone of resistance that the historical set of 3 tops here, 2184. Wherever we end up in price by the time we get to next Monday, 10.3, I expect more. It's either going to accelerate and keep going higher, or it's going to respect that time point as a outright 180 degree, like a boomerang, and come back down. That I'm not certain of. But what I am more certain is I expect in the next week further appreciation of equity prices overall. Okay. Now, is that could be the B wave of an ABC correction. If that's the case, then the C wave would bring us down, cause decline. If everything from this top here, the highest historical top of stock of the S&P, the historical high of all time, through right here, if that's just the A of an otherwise larger ABC bear market correction, and theory tells us that 70% of the time ABC bear market portions of a cycle, usually the C, the end of the entire bear market, the final 3 waves of a cycle, will often 70% or so of the time are bounded or end up somewhere in the range between the previous wave 3, that would be over here at this top, and the previous 4th wave. So somewhere in that range between this top here and the bottom on the end of Brexit. So that would suggest much lower prices to come further out, marking the end of the bear market phase of a cycle and simultaneously the onset of a new bull cycle. So that, I just wanted to clarify that. I am not crystal clear on what is responsible from a price vantage point for the price action we're seeing. The best I can say is that we had a very shorter or truncated 5th wave, because clearly this looks like a set of 5 waves. Or 4 waves, and then a very well ill-formed or malformed 5th wave. If that's the case, then the move up is a B wave, or A, B, and C of a B, of a larger ABC bear market. But again, my net resolution and view is, at least for the next 5 to 6 days, higher prices into the next time target. Again, when in doubt, from what descriptive model is accurately in sync with what you're seeing in the real world, oftentimes your time points will kind of provide that concierge type guidance. When you get lost, they will kind of bring you back to your as a homing device, back to your square one or central starting point. All right, just some intermarket connections I'd like to tie in to further argue my bullish projection and view at the moment. And that is the one I want to, if bonds go up, what happens to stocks? Then stocks rise. This is if-then scenarios. If bonds go down, stocks go down. So what we're seeing here, when we focus in on 2 specific sectors and their interaction in their relative sensitivities one to another, in general, it's a cliche, it's just a known tendency where the nominal price of any of the interest rates, notes, bonds, short-term 10-year, 5-year notes, whatever, they tend to lead stocks. And that's no surprise if you think of it from a capital flow standpoint. The nominal price of your debt, wherever you are, the IOU on the interest rate curve, however, whatever maturity you're looking at, the 30-year or shorter, it references the capacity or the tendency of financing for the corporate structure in our economy. And if the cost of money goes up, that tends to discourage investing and borrowing, and in turn that tends to stifle and put pressure on corporate margins and profit margins in particular. Stock prices go down. If the cost of money declines, it tends to be encouraging an environment for growth and borrowing, and growth in particular, and that tends to raise stocks in the short explanation through a series of hits and responses. Okay, so if that's the case, that's again the relationship, and then there are the other sectors of the economy, the precious metal. Obviously, oil is strategically, if not the most, one of them, and it's the most strategic commodity on the planet, and then the cost of money, the dollar itself. But what I want to focus on now is interest rates, or as observed by the Treasury instrument, and its impact on stock prices. So, with what happened this past week in particular, this is the bond market. It's certainly something we want to pay attention to. Its inverse is, if you think about it, is the cost of money, but the nominal is what's going on, just they're inversely related. You can see from the top here back in the middle of the summer, end of June, beginning of July, first week in July, we've been declining. If this is a fifth wave, this is your A, this is your B, this is your C, from a Elliott principle standpoint. And then we can see off of this bottom for the last week or a week and a half, we've been rising. In tune, or in response to this notion that based on the recent output of text from the Fed, that they're going to delay raising rates. I submit fundamentally that this entire ABC correction, this drifting lower on the nominal bond price, the 30-year, this is the December 30-year Treasury instrument chart here on a daily basis, is all a perception of the hiking of interest rates, of the Fed funds and the discount rate and so forth. But it's yet, we've not really seen it, and we've seen one increase, but the subsequent increase that we've been waiting for has been delayed, and with the announcement just on Wednesday, it seems it will be delayed further. There's all sorts of conjecture and thoughts as to how long and when. Well, it's funny, I had to chuckle when I saw one of the comments and responses by Janet Yellen to one of the reporters that asked, to what extent does monetary policy, or did the decision to delay raising rates, take into account the upcoming election, presidential election? And all I can say is that the Fed chairman deftly sidestepped the question. On paper, the mandate of the Fed is to ensure employment, to guard against price inflation, etc. It's very limited and restricted. In the real world, it is what it is, but suffice it to say, there was a delay. I'll leave it at that. There was a delay in a rate hike, and so the bonds responded accordingly. The bonds are now, to the extent we are not expecting sooner than later an increase in the cost of money, bonds should be rising. Well, if that's the case from the previous relationship, if bonds rise, that augurs for stocks rising as well. And so that's an argument I wanted to make. It's not sufficient to establish a position, but it does contribute to my bullishness. It's a bit of data which again by itself is woefully insufficient, but in aggregate with all the other little tidbits of information and analysis seems to make sense to suggest. I don't, just so to follow through on my reasoning here insofar as why I'm focusing on the bond as a leading harbinger of stock prices, I don't expect the central bank, now that they have decided not to raise rates in September, will do so next month. Not doing so in October, I don't think they're going to mess around with the situation in November where we have the scheduled presidential election. So the next available high probability window for which I expect it's most likely, assuming a substrate of economic releases and data that suggests it's appropriate. Because a lot, whereas the idea that the Fed will at some point raise rates, and certainly we have stopped. We're on that. We know it's not a question of if, it's when. I believe it will be at the end of the year, assuming there is sufficient data to indicate that it would not otherwise impede the recovery from our recession. But for now, at least, we see structurally, here's your one. This is a little thin on the left side because at the time, back in the spring, we were in the September contract. But nevertheless, you can see the overall trajectory in a tractor type structure, regardless of how thin. This is your one. This is correction two. This is your three. And this, or this is three. This is your four. And this is your fifth wave. And then you have a textbook A, B, C into the recent bottom of this past week. And in concert with the policy output and press conference of Wednesday, you see rising nominal bond prices reflecting lower interest rates, which in turn correlate and connect to higher stock prices. So that's, from an intermarket standpoint, an argument to suggest a propping up of the stock market and stock indices and stocks in general, at least in the short term. This is a commitment of traders report. This is the S&P, the stock market again. Let me stop before I shift gears. Any questions, folks, on any? There's a lot. Okay. Let me back up. Okay. Let me just take I'm almost, we've only 2 or 3 or 4 slides left. So does yesterday candle make cup and handle shape for a bullish move up? Good question. I don't know. So I hopefully will know if I recognize it. I can't recall. So hold on. Whoever asked that, Chet, let me just, so anyone else who's not saying, does yesterday's candle make a cup and handle shape for a bullish move up? Yeah, cup and handle is kind of a classic chart pattern that correlates with a reversal to the upside. So let me double check to see. Hold on a moment. That's a very good consideration. I might have overlooked it, so let me take a quick look. Yeah, I clearly see, if you had not mentioned it, some things are, there's so much data out there, and sometimes you can miss something. What is the cliche? They say the best way to hide something is to present it in full view. It's so obvious that you miss it. It's right on the tip of your nose, so to speak. So yeah, from the tops up here, that's the handle, and then the cup portion is the bottom on the day that the Fed governor, and then kind of rounding the cup. And yes, clearly that is a overall candle in the format. I have it in candles. It would be even in a regular standard bar chart. But yes, that by itself it contributes. Yeah, very good observation, Chet. Yeah, I agree. Now, again, would that by itself be enough or sufficient to establish long positions in the stock market? Not for me. The fact that the completion of that classical chart pattern is occurring congruent with my time window here, September 19 and 10 and October, or 9/19 this past Monday, in conjunction with the autumnal equinox of this past Thursday, makes it further intriguing. And of much further, yeah, I mean, to what extent do these coincidences transcend being pure coincidences? Is the fact that, the breakout on I guess Wednesday of this week is more or less demarking a point of price demarcation, ending the pattern, the cup and saucer pattern that Chet is pointing out, a cup and handle that is a bullish pattern. It completes its structural formation at a time that for which my time target suggests a change, is compelling, if nothing else. Again, by itself, probably not enough to put your money on the line, but in concert with all the other bits and pieces, it does make for it strengthens your argument for your particular viewpoint, certainly. Okay, good question. Let's see what's next here. In trading, fear and greed are two emotions, are bad for trading. Yeah, clearly. Well, I won't say they are present. The fear and greed are clearly ever-present, ubiquitous emotions that all traders harbor. As human beings, first, we harbor fear. fear that we're going to lose money outright, fear that we might miss miss an opportunity to make money, fear that some profits that a current position on paper has generated might devolve into be eroded either partially or completely, fear of all sorts of things, and greed, or avarice, which is just the extreme of our quest or desire and impulse to generate and capture profits by exploiting certain types of market motion. I don't know, they can be bad. They could also be, I guess in a positive sense, stimulate us into action that's constructive. But clearly, they are the two primary emotions harbored collectively by all participants all over the globe for all the financial market, capital markets that we trade in: stocks, bonds, commodities, currencies, options, all time frames, clearly. So it's key that we are aware of this and control them such that they are more often constructive versus destructive to us. Easier said than done, clearly. I get that. But yes, I clearly understand that. They've done a number of studies over the years that show, and this isn't it. I remember the first time I heard about this. Very interesting. I'm getting off topic, but just to the point here, and I'll be brief. The actual they've quantified these two emotions, and it turns out that the degree to which fear informs decision-making on the part of traders is 2.27 times more of a factor than is the fear of failure, or fear of whatever, is more important. It's 2.27 times more present than is the corresponding emotion of our interest or greed, let's say. So we are more averse to fear than we are, more often than not, is more powerful than our interest or desire for gain. Curious, kind of like analogy to sports. Fear of striking out, if you can't overcome that, you will never step to the plate to try and make a hit, I guess, from, in a basic sense. But yeah, very important comment. Yes, I agree. Do I think the Federal Reserve has fear factor set in, as they think that smooth sailing of markets should not be distributed? Or I think you mean disturbed. Maybe, yeah, I think, okay, if I hear this question correctly, I'm not sure if VJ or Sheth is asking the question. As best I can interpret it, it seems like you've written, do I think that the smooth sailing the market should, wait a minute, let me make sure I get it. Do I think the Federal Reserve has a fear factor that's set in? I don't think so. If I understand the question literally, I think, again, here's a thought, and I'm going to make it explicit. I don't really see any real inflationary commodity inflation on the horizon. If you think, I don't see the signs of that. A very odd, and I've mentioned this before in previous webinars, there is an important correlation. It goes back 100 years between inflation in a sector, in an economy, and soybean prices. A currency trader enlightened me to this relationship years ago. So I didn't. This is on the stock market, and I didn't immediately, and I can't recall where bean prices ended up yesterday. I normally keep track on an agricultural, different sectors of our economy. But so my point is this: I don't really see any strong indications from GDP of real ingrained inflation. I'm not saying it can't manifest at some point next week, next month, 6 months from now, a year from now. I just don't see it presently. There may be a little indications of some precursors of price inflation by virtue of the Fed delaying these, the printing of money in our fiat currency, in a sense. I'm being a little facetious here, but I don't yet see real manifested indications of commodity and of inflation. And as such, I don't know that the primary fear, if any, that central banks in a global, more for the long term typically have is fear of inflation. And I don't see that. If they thought so, they'd be more inclined to all other variables set aside or fixed, be sooner than later acting on that fear and be more, and that would manifest by a tendency to sooner than later raise rates. So my answer would be I don't see that they are being motivated by fear if the fear is primarily that of inflation. And I think justifiably. I don't really see any indications of inflation that would warrant immediate response on the part of a central bank or a regulatory body such as our Fed. Okay. Now, if you're meaning fear of, if maybe I've misinterpreted your point, if you're instead referring to fear of by too quickly adjusting the cost of money or decreasing money supply, and as such stifling and hindering our economic recovery. If anything, I think that's a concern. I don't know that I wouldn't call it a fear, but I think that's more immediately at an issue. That coupled with, and this is my pure conjecture. This is my fanciful, whimsical, capricious thoughts and conjecture. So this is not part of my program, but it's nevertheless it shapes all of my views. I do believe the bank, as you know, it has an element of political consideration, and I think there has been a tendency historically for our central bank, and I'm being very specific here, to kind of have a policy of avoidance in and around a presidential election. So if that constitutes fear, whatever language we want to use, so be it. But I think there is a tendency to want to have a hands-off monetary policy by the bank, on the eve of a presidential election. Call it what it is. I think that's what's it. I think those factors are kind of informing policy right now by the bank. They think that smooth sailing of markets should not be disturbed. Yeah, I think they want to leave it alone. Yes, so I agree with your conclusion. However, they've come to that. I think I'm seeing the net resolution, and that's what I'm attributing it to. So I would concur. Okay. Oh yeah, thanks VJ for disturbed. Yeah. Okay. So so let me go back. Continue. And I wanted to have another piece of evidence. This is the correlated intermarket reason, or a reason, with an expectancy. If this is the structure, now one of the things that's hard to predict is if this bottom here, this little tail on this candle here, if that is the start of a cycle, which I expect it is. In other words, if the top here is indicated by my horizontal hash line or crosshairs, marks the end of a cycle, a bull cycle, the fifth wave. Again, 1, 2, 3, 4. That's, I know, a little thin when the market, because we were trading the September contract at the time. This is the December, but you can nevertheless see the obvious adherence to an attractor of the Elliott principle. This is the 1. Correction 2, that's about a 62% retracement Fibonacci pullback. This is your 3. That's a little small 3. Either 3 is here or here. Either way, you had this is your fourth wave, or this is the fourth. Either way, this is probably 4 because it allows for a segmented fifth all the way up to the top. Okay, so if this little triple top area is your fifth wave, the end of the bull portion, the first 5 waves of a market cycle, you have an ABC correction. Theoretically, this might be the A. This is an obvious pivot point. This could be the B of a little zigzag type correction. And these bottom areas in here, this bottom here 3 days ago, could be your C. Theoretically, what happens, and it perfectly complies with theory, and I mentioned this on a previous slide, not to be a primer on Elliott, but 70% of the time, the end of the entire ABC is going to find itself being bounded between the end of the previous 3, which is this top here, and the end of the 4. Well, look at, it's kind of a deeper ABC. It kind of, look at that. If this is the end of 4, it kind of is right stop. That's not coincidence. It is in tune with the theoretical ideal. The entire ABC correction, the final 3 waves of the cycle, in this case, was stopped by the end of the previous wave 4, while the market was in the upsurge portion in the first 5 waves of the bullish cycle. Okay. If that's the case, my point is this. This would be a wave 1 of a new bull market cycle. Seminal waves, the first wave of a cycle, are notoriously challenging to forecast in terms of how far they're going to go. That is, come up with a price target. There are some techniques, some mechanisms, some relationships that I am aware of that enable, outside of the Elliott wave, to generate a valid a reliable price target for what you consider and define to be a wave 1. But it's harder. Wave 3 is 1.618 of 1 often. But wave 5 is 62% of 1 through 3, as I mentioned in my global long-term projection to get an overall price target for the stock market of 2680. But wave 1, first waves of any beginning cycle being the seminal seed, if you will, of the move, out of very difficult because it is the source. So everything else is dependent on it. It is the independent variable. How do you forecast it? Well, as best you can. That's why, for example, sometimes it can't be direct. And that's why what I would, going back quickly just to remind you, this sometimes indirectly, to the extent I have a sense of time. How long is the run time? I could indirectly imply, or the amount of time for which you expect the wave will last, suggest circuitously, in a sense, in a roundabout way, how far it could go. The greater the amount of time you expect the system to will have to move, the greater distance it could travel. So at least in a qualitative sense, it begins to get you in the ballpark of areas of price targeting, if not a precise target. That's all. When all else fails, sometimes the time element that if you have what you expect is a reliable time projection, it will indirectly guide you in terms of a probable zone or region or range of price targets. Nevertheless, qualitatively we see and on an if the bonds move in concert with the stocks, that would give you another week of this current motion. Not saying that that is the case. That's a different thing. But we're able, given certain assumptions, to make further assumptions that sometimes can prove enlightening and shed a little greater clarity in terms of understanding the current system of a market, where it currently resides, and if you have confidence in your current state assessment, you're then able to extrapolate or project that current state into more probable projections as to how you can expect that market will move going forward. Okay, so this is my argument based on an intermarket, the tendency where nominal bond prices tend to lead nominal stock prices, and it's going up based on a wave structure that I see, also which is in perfect reconciliation with the recent this Fed decision this past week. Okay, commitment of traders report for the stock market. This is very curious. A couple of things on this chart. This is the bottom I referred to on a previous slide back in January 20. Here's the bull cycle that clearly textbook, almost textbook. If this is the start of wave 1, this is, I know this in my head, January 20th bottom. This is end of wave 1, correction 2, almost 100% retracement, as wave 2s are apt to do, very deep retracements, creating what a classical chart interpretation would call a double bottom. Your classic wave 3, either you end wave 3 here or here, either one of these tops, doesn't matter. And then all of this stuff from either here or here through the end of Brexit. Remember, I had a time target right here. I was one day late. This is the 27th of June, the actual bottom. I projected weeks prior to that a date of return on the 28th of June. I was one day late. More or less the same. I'm not touting me, I'm touting the relationships. Okay, and then what I expect from this bottom here on June 27th through the top, August 20, whatever that date, August 23, depending on which index you're looking at, it might have been the 23rd or the 24th. I know in the ES it was the 23rd, if I recall. Yes, the spiders might have been the 24th, but it's within a day or of each other, depending on the Dow, the Russell, the NASDAQ, the SPY, etc. More or less, that's the historical top, and that I expected was the end of a fifth wave. If that's the case, of a particular degree, then I thought this was the A, B, C that was forming, and it could be maybe this is the A, and then we're going up in what would be a 5, or maybe I have that description or count incorrect. I don't know. In other words, it would be my reason to expect there's further declines in order to complete a formation of a C is because structurally where this bottom is at 2100, it doesn't quite conform with theory in that ideally the entire ABC correction, 70% or so of the time, ends up being bounded between, if this is wave 3 and this is wave 4, a little deeper. with 2100, the end of wave 3 was up here at 20, whatever this is. I can interpolate it 20, this might be 20, I don't know, 2070 area, this top in here. So we didn't get quite deep enough. Doesn't mean it couldn't be the entire ABC correction, in which case this would mean that the move up off of the bottom 2 Mondays ago through where we are yesterday through the present is the new bull market cycle, wave 1. And that would be a reason to expect higher prices for however long that first wave you can expect to last. Alternatively, if I do have it correct with my initial thought, and that this is a 1 of an A, a 2 of an A, a 3 of an A, and a truncated 5th of an A, all the breakout through today or through yesterday is the start of a B, of a larger ABC correction, however high it goes. If you have a flat, I would expect it to be bounded by the 2184 price zone of resistance. If it's an irregular, it could break up to 2195 area. If it's a zigzag or a triangular correction, it probably is not going to go much higher, but I have discounted that because of other forces and factors. I expect it's higher, but I can't, it's not 100% certain just based on the confluence of all the things I have. But from my search from a standpoint of understanding why it's going up, to give me greater confidence in my projection and forecast. Okay, so it could either be a new bull cycle, wave 1, or the B cycle that's beginning with this higher bottom here. This is your truncated 5th. If it's the end of a 5th of the entire ABC correction, it would either, it's the start of a 1 or a start of a B. Either way, that proscribes and suggests higher prices, at least in the near term. Okay. Now, a completely different insight or probing mechanism, the commitment of traders, which is just an accounting by the CFTC. The red line are the commercials, the green are this large institutional money, the blue are the small specs. Okay. What's interesting here is the nominal level of commercials to some extent serves as a future forecast, a future snapshot, a preview of coming attractions, as the commercials do, because they account for between 70 and 80% of the volume of all markets. That tends to indicate what the price is going to do. But the catch is there's a lag, and this is where it's a question mark. How do we, and this is why you don't make it, I wouldn't make a trading decision solely on this. It's a pretty reliable indicator of what's to come. What's not so reliable and what's more harder to specify is the window. What's the lag time? A month, 3 months, 6 months, a year, 3 years? I don't know. No one knows for certain. So we utilize other things to sometimes narrow that window to get a finer sense as to when, more precisely, the relationship that's specified by the commercial activity. Well, that's just one. So clearly we can see the commercials have been, they've gone from net long position. This vertical axis is indicates net. If it's below 0, here's your 0 point. Anything below is net short positioning. Everything above is net long. So when they're currently, the red line is the commercial activity. They move the markets, but they are typically at opposite position to the trend. This is why the large money, the institutional hedge funds, commodity pools, mutual funds, etc., big banks that are serving investing purposes, trying to, for the purpose of making money, more often than not, they will attempt, if not successful, at least attempt to be in sync with the trend. That's how you can make money. That's the only way you can make money. The blue line are the small traders. What's important about the blue line, or small specs as they're referred to, is that 80 to 85% of the time they're wrong. For whatever, we don't need to worry about why, how, so forth, but that's an overwhelming skew statistically. So I find, this is why I thought it was important to present this slide as in this text, in this context. Notice, if, again, the commercials are net short, which in and of itself is ostensive, on the surface it's bearish, and they are at their most short position, or not most, but they're net short, so it's bearish. But what dampens the bearishness is the fact that at the same time, simultaneously, we've got the small traders somewhat bearish as well. If the small traders are wrong most of the time, 85% or so of the time, that indicates that they're probably, the majority of the time. Now, two things obvious. This could be one of the 15% of the time that they're right. It's possible. I cannot rule that out. Or it's more likely to suggest, more likely on the spectrum of probability of what's more plausible, that soon I can expect the commercials will shift their net position. It's not absolute. I'm just saying, to the extent 85% of the time, whatever it is that the blue line is doing, it's wrong. So use that as fade whatever the small specs are doing. If they're net short, kind of just slightly above what the commercial position is. Both are net short currently. The fact that's an odd situation. More often than not, it resolves where, in a way, not where the small specs, whatever it is, it typically resolves much more frequently so as to end up such that the small traders are still wrong. So that would suggest a more probable shifting on the part of the positioning by the commercials to go net positive. And that would be positive for stock prices. It's not woefully, again, insufficient by itself to support higher stock prices for any window of time. It just is an argument from a different view to suggest higher prices are in the offing. Okay. One thing I saw that's why I wanted to present this slide. Notice here we've got this lavender or purple line is open interest. The vertical green and red bars are volume. So volume is coming down. That's not price supportive. That is bearish. I got to call it as it is. That's a counter or contrary indication to my view of expecting higher prices. But open interest is slightly rising. Clearly it accelerated while, back here was when we were coming down. That was kind of right, high volume, high open interest. That reflects a lot of trading, a lot of business activity, and the type of activity in the net is more selling, more sellers establishing new shorts. Right now, while the price is rising and open interest is rising as well, that's new buying coming in. That is by itself bullish. So that kind of offsets. We've got rising open interest indicative of new buyers are what are primarily in the net responsible for pushing or bidding the price higher, but not a meager amount of volume, but not the highest. So what I would be looking for moving forward, starting next week, is rising volume and a sustenance of this, an increase in open interest. To that extent, that would give me confidence that I have my direction correct. But price-wise, time-wise, bullish. This open interest thing, or the commitment of COT report, the commitment of traders, is very odd or curious in that rarely do you see the small specs aligned for any length of time. Although you can see it here since August. They've been in a similar side of the fence in terms of net positioning. I don't expect that's going to last long. And I'm working on the vent from the interpretation that more than likely the commercials are not going to be wrong. They're always right. They're just right ahead of time. So with regard to what you see, if from that vantage point, that tells me to more likely expect this is going to be one of the 85% of the times that the small specs, as they typically do, are wrong. And in order for them, I can't have the commercials being wrong while the small specs are wrong, and as such, something's got to change. As such, it does more on a continuum of, based on statistics, suggest more likely commercials are going to change their net positioning and transition to the net long. Okay, so we shall see, but that's just my interpretation of what's at play currently with this commitment of traders. This is another intermarket relationship. A lot of traders that I consult have been referring to, there's a lot of things going on in our world, precious metals, gold, silver, platinum in particular, as harbingers of calamity and uncertainty and financial paper asset collapse, etc. Go long as a hedge in precious and gold and silver, etc. Okay, whatever. Here's a thought. Structurally, I think that everything, you can see clearly this move from this bottom here in June, end of June, up to the top is an impulsive structure. So this top here in July 5th to be exact, I believe, in gold. I know in silver it's also the 5th. It's either, it's either at the end of a fifth wave or it's the end of a third. In either case, you have a classic triangular correction wave, which is very often a fourth wave, or it's an ABC. Either way, you can see, and I've put in the lines to indicate the classic structure of a triangular pattern, which is 5 waves: A, B, C, D, and E, which completes, theoretically, the normal formation of a triangular correction, be it if this is a fourth wave triangle or if it's an ABC triangle. You have structure from this top, July 5, all the way to this bottom a week ago, whatever, I don't recall the date there, but this top is the top here. The highest point on the screen is July 5. I know that for sure. This bottom, just 1, 2, 3, Monday, I guess, or Friday, the previous Friday, whatever it is. And then we were seeing appreciation in both gold and silver in concert, in sympathy with stock prices. That's a little odd, but it's not, because I don't want to get off on the intermarket correlation. But at some point, here's my thought. To the extent I see further appreciation and bidding up of stock prices, I expect a decorrelation with the metals, where they'll come back up. My next time target for gold and silver, I haven't indicated on this chart, is October 24. They've got a lot of important cycles coming up in next month, October. Here's a thought of acid test thresholds to help us in our decision making. As long as the gold, precious metal prices stay in this restricted range, I expect that to be constructive for stock prices. 70–80% of the time, the breakout of a triangle will be in the direct of any, this is generic, I'm not just talking gold and silver, I'm applying it to the precious metal sector now, because we've got a very idealized like structure and formation of this triangular pattern. A, B, C, D, E. So what happens at the end of the E wave? The triangle formation completes, the next impulsive portion of the market cycle ensues. That would suggest that everything from this bottom, the beginning of last week or the previous Friday, I can't recall exactly how many, this is yesterday, Thursday, Wednesday, Tuesday, Monday. This was this black candle at the bottom, the end of the base is the end of the triangular pattern theoretically. As such, everything from this point, theoretically, if it's following and adhering perfectly to textbook theory, suggests it's a new impulsive start, either a new bull cycle, a wave 1, if this is a fifth wave top on July 5, or alternatively, if this top is the end of wave 3, this would be the start of a fifth wave. Either way, the net qualitative direction I would expect immediately, while this in response, at minimum, it must break through the wall of the upper side of the triangle, is higher prices for gold, and this chart on silver and platinum is basically the same. I trade silver or a derivative of such, like SLV if you're on the ETF side, etc., and securities. But I did gold because it's kind of just in a general sense, a standard bellwether type capital sector market that everyone is aware of. Okay. So here's my thought. As long as gold's prices, if maybe we're going to have a malformation and we'll have another wave staying within this restricted range, getting closer and closer to the apex and tip of the triangle further out into next year, the beginning of first quarter of next year. Or maybe it's going to break through. So I'm using the price of the precious metals. I told someone yesterday, one of the people I talk to regularly, if this is the end of and silver, the structure is a little different. It's not quite a triangular pattern. It's more of a what we call a flat type correction. And I said we have a wave 1 price structure. On a break, if it's a wave 3, an impulsive portion, wait till a break is out. You also had a Gartley pattern, but that's getting into silver. But clearly in gold, we have a triangular pattern. Either it's going to persist, close moving where theoretically it breaks out about an inch before the apex, further out into time, and that would maybe be into the middle to the third week of November, and that would be what was defined as complex correction. Or it's going to complete right now with a singular triangle set of 5 waves, and this is a new, either wave 1, if this is the end of wave 5 up back here on July 5, or what would be the starting move of a fifth wave. In either case, well, here is this zone, the lower succession, the succession of lower tops, the July 5 top, and we'll see if this forms another top and respects that descending trend line, or if it violates and breaks through. but that more or less will provide an indication indirectly to me as to how to gauge my long position in the stock market. You see, depending on the market's response as it gets more and more proximal to this declining line of overhead resistance that is formed in response to the historical tracing out on the gold successive lower and lower tops. So we'll see. To the extent gold breaks through is the extent I would expect, in retrospect, this was more of a significant bottom, and then that would correlate with a more significant topping in stock prices. Even though for the last week, in response primarily to the announcement by the Fed, they are going to have a delay in raising cost of money, raising interest rates. And initially, even though in general we tend to think metals and stock, paper assets and hard assets move counter or inverse, opposite, sometimes they move, usually initially they will move in concert until the move in the stocks is extreme or persistent. Then you'll see it decorrelating where the metal prices will move they will decorrelate and get off that train and move in the opposite direction. So I'm looking at it from the opposite way. I'm saying allow gold behavior, the price in the precious metal sector, to kind of indirectly interpret what I can expect more precisely. When do I expect the topping in stock prices? When should I be taking profits on my long positions in stocks, in a sense? If we see a breakout here above resistance, if the price of gold and silver breaks through the resistance, that's an indication that we're at or near at pivot point, a top in paper assets or in the stock market. If we see persistent, it respects this and bounces back down for another wave down to test a lower side of the triangle, that's an indication stocks are not done yet, and there's further appreciation in paper assets, particularly the stock index and stocks in general. So I'm using this as a kind of an indirect gauge by which to interpret and monitor and adjust positions in the stock market. All right. One other factor from an intermarket correlation standpoint I wanted to make explicit. Lastly, pure trend. When people ask me my analytical totem pole of importance, trend is always at the top. I implied that earlier at the beginning of today's presentation when I mentioned, even though cause and effect, to me, the primary promulgators of that are time relationships, and that is true. But time, error, it's arbitrary. Error can creep in. I might misread it or misinterpret my time periods or my time projections, or however reliable historically they are. It doesn't. I don't know. There's all sorts of issues that create problems, or that in general time analysis is in a broad sense more problematic. Trend as an extension of price is ultimately it's always correct by definition. It is what is the reality. And so as a rough gauge to that, this red line is, if you can, or whatever color it looks like, I don't know if you can see it, it was red when I printed it out, but it's a 50-day simple moving average. And curious, the markets closed yesterday just above, or just resonant, it's right, you can hardly see it, it's just above that 50-day. The 50-day average acts for various reasons more or less as a price magnet. And so based on the market's behavior with respect, or vis-a-vis that 50-day simple average, is very often very telling. In a broad, when people say how should you be approaching a stock, a bond, a commodity, any financial system, one of the first things I always do is, where is it trading relative to that 50-day simple average? Is it above? I immediately, in a very broad sense, think in terms of exploiting the upside or the bull side of that trade. If it's below, I tend to shift my thinking towards going short or bearish. That's all. So as a final definer or definitor of what I can expect, it's curious that we are at that 2158. That's an area, we're at a critical juncture. The fact that the close yesterday was just right at that 50-day simple average is very telling. It's very interesting. To split the hair analytically, it is above that 50. So it is in concert with the majority of data bits that I'm deriving. Now, that could change at any moment, but I'm just saying, at the moment, given where the market is with respect to proximity of the 50-day. It's slightly, ever so slightly, a tick or two maybe above or right equal to that 50. So that just wanted to present to give us added context from a pure trend standpoint, what's going on. Where is the market based on, you know, trend analysis from utilizing a very specific indication. And as such, it would still, that would be in concert with the bullish view at this point. All right. Folks, that concludes today's presentation. Let me see if we have any additional questions since the last time out that I took to address any questions. Glenn, do I use VIX as another indicator for confirmation of S&P 500 as they are opposite to each other in trading? Yes, I'm actually, I haven't talked about the VIX much, and I should. I remember at the first, just as a note of context, guys, one of the first things years ago when I was learning, and I'm still learning, but hopefully, but I had someone ask me, a person I consult earlier this week, to go into detail on the formulas on the VIX, and I realized that I had forgotten a lot about the VIX that I once knew, and the formula and the creation of the formula and so forth. But the interpretation, whoever's asking the question, yeah, I certainly consider the VIX. I do it kind of implicitly because I know how to interpret it. I have not talked about it explicitly. I'm actually getting together a set of modules to instruct some of the people and traders that I work with on the VIX in particular in varying forms of interpretation. But yeah, I do look at the VIX, and certainly it is part of my consideration in my views that I reach. Okay, let me see if there's any other. Okay, do I use the VIX or another indicator or as an indicator? Yes. For confirmation of the SPY, yes. That's clearly, yes, I do, whoever asked the question. What moving average line have I, that's a 50-day moving average, VJ and Sheth, I think they're both asking, or I'm seeing your names, or that question. That's a 50-day, simple. I use that in conjunction, you know, the you'll see on a lot of charts, a 200 simple, a 50 simple, a 20 simple. I actually use a 50 in concert with a 21 and an 8. 8, 5, 8, 13, 21, those are Fibonacci numbers, obviously. 55, 50 is not quite a fib number, but it's one. The reason I often traders use 50, because a lot of big funds utilize the 50 as a short term in conjunction with the 200. And so the crossing of the 50 up above or down below the 200 often generates macro signals for big money funds, hedge funds, commodity pools, etc., mutual funds, big capital flow, whether you get out of assets and go to cash, go to the sidelines, etc. So we often find that these longer term simple averages serve as magnets to which the price will revert, mean revert in a sense. And often, so I use the 50. I'm not controlling or running very, large sums of money on the order of tens of millions, if not much less, hundreds of millions. So I utilize what a lot of the very large funds utilize as the short term. I use that as my long term, and I get a similar impact. That's why I use the 50 as a definer of, in a global sense of trend. My long-term horizons for being in swing or position trades is, usually on the order of maybe 2 or 3 months. Every now and then I'll do a spread, a calendar going out for a year, maybe a year, but that's the exception, not the rule. All the way down to my intraday day trading, and I'm not even using that averages in general for day trading. And if you want to get more defined, you can use like a shorter term period, like an 8, and you might do an exponential to get a finer, response, or even a shorter term, a 2 period or a 3. But yeah, but yeah, that was a 50 on that. Okay. Folks, okay, I think that's the end of the questions. I'm not seeing any more. Let me just see. Oh, thanks for your, thank you for the, let's see. What moving, okay, yeah, it's a 50. Let me just scroll the questions. So right now, price is respecting the 50-day. It has come right back to it with yesterday's close, yes. A little more response to bounce. Well, let's see. But yeah, we are at a critical juncture. Even if I didn't have the 50 I put up there because it is a good, it acts as a magnet to price. 21.58. Curiously, I forgot to mention this. I didn't 2158 for a number of reasons, based on a number of. I used a square of 9 chart. If you're familiar with that, I used what's called a nonagon chart. That's another more esoteric Gann instrument that I utilize to generate price levels. I also use a different harmonic, a certain numerical formula I use to generate price. I also looked at the screen and saw the historical tendency for the market to form tops and bottoms in or around 2158. 2158, folks, is very important. Now here's the thing I forgot to mention. I projected if 2155, now this is not bullish, this is bearish, is a price target for which I projected at the end of a 5th wave. 2155 and 2158. That would tell me, that's a piece of evidence to suggest we're not going to go higher. I forgot to mention that in the spirit of being, pointing out explicitly all sides of a, I generated, this is so important. Let me go back. Well, let me just say 2155 to 2158 is an important target. I projected 2155, 3 points below 2158, which for other reasons I expect is in a critical level, which is where we settled 0.1 yesterday, close of going into the weekend. 2155 by altogether Fibonacci projection for where I would expect the where the 5th wave of the cycle that started back at the bottom in January 20th on the, if you recall the daily chart I showed, would be where the wave 5 theoretically would end. That would indicate, or more like, that's a bearish component. I don't want to not make you aware of that. That's an argument to suggest we are going to come down now. Well, it doesn't necessarily mean we can't go higher. That's why I'm going. If I thought that were ruling or overwhelming, I would not have gone long. But I just wanted to mention, I don't think these numbers are coincidence. I projected the end of a 5th wave of the particular set of 5 waves that we showed on the chart began back at the bottom in January 20th. My target for where wave 5 would end was 2155. Curiously, just 3 points away from 2158. I don't think that's coincidence. So we are at an important price right now, and I just expect that the run time for the move higher conservatively will be through at least another week. Again, my next time target, October 3rd, which is a week from this coming Monday. All right. Let's see, any other? So right now price is respecting 50-day, yes. And yes, thanks, Glenn. Okay, thank you for appreciating and showing up, guys, for the program. Technologists for me. Thank you, Sheth and VJ, and anyone else there. And on that note, folks, I think we're out of questions and out of time. If you have any interest in more of the details of how I do my analysis, contact the Academy. Here again is the contact information on the screen at Pacific Trading Academy, 1-800-339-8588. Or you can look at our website, www.pacifictradingacademy.com. Peter Newman, head of admissions and internal activity, and he's the one. So every now and then, more recently in the last year, he has put me in contact with people who have questions. When I'm available, I'm happy to. This is a passion of mine, as you guys know, for those of you who have attended previous webinars. If you're new to the program, welcome. Hope you come back for future topics. I may be doing, since someone asked me about the VIX, that's a topic that I don't know if I've ever done, and because I'm actually creating some modules for a student who's interested in particular, I'm preparing this weekend to go into some depth on the VIX. I have a lot of people that I've instructed over the years in options, and volatility is key, and it is a volatility index, so clearly, so it may be something I would do in the future, a topic specifically on the VIX and the ramifications of interpretation concerning different trading strategies and how you can incorporate the VIX to that. We have recorded today's program, so if you'd like a copy, you can access the website and the archives for that. If you have any specific questions, you have the information. Again, Peter Newman is the person that would address those questions. Until next time, folks, again, have a great weekend. Great to talk to you. Hope you've enjoyed it and got something out of it, and wish you profitable trading in the days and weeks to come, and look forward to our next coming together. Talk to you then.